Chris, so I thought we'd cover it's a great opportunity to kind of share some of the slides with our listeners that we do with clients, right? Stuff that keeps us in perspective of what's going on in the market.
Yeah, we have a lot of stuff that comes across our desk, slides, charts, the whole nine. There's few that we look at and say, hey, that's an all-timer. That's, that's something that we need to keep saving our desktop. We're going to go through some of those today. The first one that comes to mind is the size and frequency of declines in the market.
Yeah, this one's always a big surprise, right? Because a lot of people, I tell clients all the time, the intra-year declines, no one remembers. They just remember what the market did at the end of the year, right? Yeah. Right. And so why don't you run us through kind of some of the history of those?
Yeah, so if we think about categorizing the different size of declines, Capital Group has a great piece where they put the size of the decline and then how often that actually takes place. So, for example, we have a 5% or more decline twice per year, a 10% or more decline about once every 18 months, a 15% or more decline once every 3 years, and then furthest to the right, these are the ones that are brutal 20% plus declines about once every 6 years.
I think that's the one that surprises people because those are the ones, right, people remember. They remember the 20% declines, but the fact that they only happen, on average, no, not always, but on average every 6 years, which means you've got a pretty good run in the market, and they tend to be, these are going to be your bear markets. Another great one we talk about slides is time in the market matters, not market timing. So this is a lot of conversations we have with clients about not trying to time the market because, as we know, it doesn't typically benefit you.
Absolutely. This is a great piece by Capital Group that shows if you invested $1,000 over the 9-year period that they're using from 2015 through 2024, your money would have almost tripled. That's if you just left that, rode through the ups and the downs. And then what's important is if you missed the best days during that period of time, and a lot of times those best days come right after
the
really
worst
tough days, then your returns would have been substantially impacted.
Yeah. So great piece. So again, just, this is a reminder that if you're going to be in the markets, you got to be able to ride out those ups and downs because it will benefit you in the long run and not to time the market.
Absolutely.
All right. So Chris, another great one to talk about is making a plan and sticking to it. When market starts to fall down, we tend to see clients who say, oh, let's stop putting money in the market or let's pause my contributions. And in reality, what this really shows is that's the best time to buy.
It's natural. It's natural for the market to be declining. And then you say, hey, am I doing the right thing by, putting more money into this? I don't want to throw good money after bad. And in actuality, this is the time that you want to be putting money to work. If you have a 401k, if you're somebody that's younger, bear markets actually present the opportunity to put money to work at better prices.
Yeah. So I always tell clients, hey, don't you like to buy things on sale, right? So the market just went on sale. It's an opportunity to buy more of something you liked before, at a better cost, and you're going to get more shares.
Absolutely. You have to have a plan. At the time you're doing it, you're going to feel uneasy. You'll thank yourself 5-10 years later. On to our next market volatility slide, annual returns versus intra-year declines. Great piece by JP Morgan showing the different aspects of market performance going back to the 1980s.
Yeah, it's amazing. If you look at it, you go, well, every year at some point in the year, almost every year, I'm trying to see, you've always lost money.
Right.
Sometime during the year.
Right. Of average 14% decline over that data series. The way that I look at this is if you're not prepared to lose 14% at any point during the calendar year, you shouldn't be putting money to work in equities. And that 14% to me is almost the price of admission for investing in stocks.
Yeah. But if you look at what it says, but 34 out of those 45 years, the market ended up being positive.
75% of the time.
Yeah. So it's not what happens in the middle of the year in this short condensed period of time. It's about the long term, and a year isn't even the long term. So we get focused on what's happening in the here and now, and we need to keep broader perspective.
What we're looking at here is another all-time chart from ClearBridge. This shows investment return versus investor return.
Yeah, it's pretty interesting, isn't it? And how do they come up with this average investor return? They look at flows in and out of mutual funds and ETFs of when people are buying and selling to come up with this average.
Right. And if we think about this research, this isn't some sort of, pie in the sky study. This is actually real world data.
Yep.
And all of the things that we see from fund companies, either on their prospectuses or their websites and whatnot, all the things that we see in the media, all of those quoted return numbers, those are all in a vacuum. Those don't have money coming in and out in all sort of real world scenarios. This shows that if you would have just bought and held stocks, you would have earned approximately 10% per year over this 20-year time period. The average investor is earning 3.5%. Pretty wild.
That's not good. That they should be, that's the emotional aspect that they need to take away from their portfolio is don't get emotional. Don't make these crazy buys and sells. And if you stick to the just buy and hold, you tend to do better. And this chart clearly shows that. Well, this next slide is pretty cool. I really like this one. Panic attacks in the S&P 500. This is from ClearBridge. It's just showing us some of these things in the past that we remember, but maybe getting a little hazy. The Y2K.
Yep. Everybody thought the world was going to end.
Yeah. All the computer numbers were going to change and no computer was going to work. Market was down 12%. What did it do after that?
And then after that, it was up 378%. Yeah. So again,
crazy.
It's unbelievable. And the best part I like about this is you always hear clients go, this time's different, right? Whatever we're faced with, whether it's tariffs, everyone forgets the tariffs in 2018, or there's other periods where we had the oil and going back. But, we've seen some of these things. They might be dressed up a little different. Maybe they're wearing a different outfit. But the reality is that, as investors, we've had all these various scenarios that have caused these big pullbacks in the market. But if you look at the long horizon, for example, the global financial crisis, that was very painful, down 48.8%. But what's it up since then?
300%.
Yeah. So, crazy. Great opportunity to buy, right? We talk about things being on sale. So, it's that tunnel vision. I always tell clients, don't focus on what's happening. It's the long game. And, if you're diversified, if you can stay that long game, you will be rewarded in the long run. Yep. So Dan, this is a great slide, diversification. This one's by JP Morgan, and we call this really the jelly bean chart because all the different colors.
Yeah.
It goes through and tells you the different parts of the market, like large growth stocks, REITs, commodities, small cap stocks, and equities, and how they've done each year. And what's best is there's no clear winner across every year.
No, for small periods of time, you go, oh, this one, like REITs, did really, really well at the beginning of the 2010s.
Yep.
But then they
Not
didn't
so
keep
good.
doing
Right.
well. So it's color coded this way, so you can say, well, where's the pattern?
Yep.
And you go, well, there really isn't much of a pattern.
Yeah. And then what this shows is if you're diversified and you spread your risk, so you maybe owed some REITs, some small cap, large cap stocks, bonds, and then you see that white and it says, well, now your volatility is a little bit more manageable, right? You don't have as big of swings if you were just to track that one sector of the market.
You sort of stay in the middle. You still have volatility.
Right.
But that volatility isn't like this. It's more like that.
Which, hopefully your heart rate's not like that also.
Exactly.
Yeah. So this just, again, hits home on why it makes sense to make sure that you have a diversified portfolio and how, any one category is never going to be king for the long term.
No. If there was, everybody would have all their money there.
Right. Yep. It'd be easy. All right. So Dan, this is a great one by Hartford. This slide talks about long-term averages versus data because almost everyone thinks, oh, the market has done 8 to 10% over history.
Last 80 years or whatever it is.
Yeah, that's the number you typically hear.
Yep.
But what this really shows is the buy-year returns and the painful, which is on the left side, anything that's been 20% more of a dip. And ironically, more people would think there's more years than what's listed here.
I suspect so.
Right.
If you look at the exceptional years relative to the really painful years, there's far more exceptional years than there are painful years.
Right.
But you got to go through some pain to, get to the exception.
And the funny thing is that we tend to focus on the pain, right? People go, oh, I remember that when it was down 20, 30%. I remember that year. And they tend to forget those years where clearly there's more than 3 times the number of painful years, exceptional years than there were painful pullbacks. And it's, we tend to focus on those drawbacks and those burn in our memory of that being a bad time.
Yeah, I think the pain you feel the pain more than you like the upside, right?
Right.
I loved riding my bike when I was a little kid, but I remember the falls and hurting myself more than I do just riding the bike.
Oh, that sounds terrible.
And so that's, I got some scars to show it, but the pain, people feel it more.
Right.
And so that's why when we're going through these, that we have to focus more on remembering, hey, there's some really good times behind us and ahead of us.
Yeah, what I think is just great about this is there's only been 6 years where it's actually been between 8 and 12. We've had way more exceptional years. I mean, in category. Yes, there's been some painful, but it really goes back to show you that long-term perspective. And, and typically if you really hone in on this, the painful years, the exceptional years typically follow that painful year.
Yeah. Yeah. Almost not quite in lockstep, but pretty close.
Pretty close. Yeah. So just a key, stay long-term.